What's up, you guys? Stephen Vanderhook back again, starting our October Halloween series of scary financial advice that I've gotten over the years. And what's more scarier than this terrifying mask? So, first of all, if you know what that mask is from or what it represents, comment down below. I'll give you a shout out next video. Second of all, I one time went to a Halloween party wearing that in all black, and I show up, and there were little kids there. I immediately took the mask off, and I was nothing. I just was wearing all black and had no real costume after that, because it was not the most pleasant experience. Before we jump into today's video, just wanted to let you all know I'm going to start doing something a little different. I'm going to end all my videos with different quotes, whatever they are, lyrics, poems. Let's be honest, they're probably all going to be just metal lyrics, but different quotes that have inspired me over the years that I think are really important and have made me think and reflect. So I want to start ending my videos with those. Hope you enjoy them. Stick around for those. For our first Halloween topic, we're going to jump into the scariest ways to get rich. Now, one, there's gambling. Pretty scary. Probably going to lose it all, but hey, maybe you get rich. Two, there is, importing and exporting or logistics of different consumption goods that may or may not be available in stores, if you catch my drift. Number three, there's always the get-rich-quick scheme sold to you by a Chad on YouTube who's giving you an ad with him sitting by a Lamborghini saying, hey, I did it and you can do it too. Those are always terrifying. And number four, what we're going to really focus the video on today is a method of getting rich that was promoted pretty heavily. I read a book. I'm not going to give the title of the book because I'm going to slam it completely and throw it in the dumpster today. But if you know this book and these sound familiar to you, I'm interested in what you think as to whether or not these ideas are good or not. But the whole idea is how to become a millionaire by the age of 30. And what you can do is basically just leverage your life away. It is the whole concept of the book. So the entire book is very repetitive. It just gives various examples of the exact same pattern. I'm not going to go into all the different examples because, again, it's really just the same thing. But basically, the whole idea is that you start when you're 18, right? And then you can be a millionaire by the time you're 30. And what you do is always take out debt on everything you buy and use your extra money to invest at a higher interest rate. So leverage is not a new idea, right? That you borrow at 4% and then you invest at and make a gain of 8%, well, great. There's a net 4% gain there that you're gaining on someone else's money. That's not necessarily a bad idea, right? When you're a business, I mean, all the businesses in the world, they don't operate just on equity. They all have leverage, they all have debt, and they use that for their business models. But there's a really big difference between a business and your own personal life, right? And they don't really distinguish between the two in this particular book. So the idea that you can just take your car is the first example, right? Of saying, hey, I need to buy a car. I want to buy a $20,000 car, and let's say I have the $20,000 in cash. Well, they say, hey, don't do that. Go and put 20% down. Go and put $4,000 down, and take the extra 16 grand and invest it over the next 5 or 6 years if you get an 84-month term, and invest that difference. Your auto loan will only be 3%, and you'll invest the difference, that 16K, at 8%, and then you'll have that net 5% gain that you're just getting on all of that while you're paying off your car. You're just letting that cash sit in an investment. Now, that's really, really risky to do when you continue to do that on every stage of life. And they do give some disclaimers to say, hey, make sure you do invest, because obviously most people, when they hear this, they're going to put that $4,000 into their car and then they're going to go and spend another $4,000 on maybe a second car or a motorcycle or something and have two different payment now. And that's what they're saying, hey, make sure not to do that, right? Be responsible and make sure to actually invest. Don't actually increase your spending. But that's just not human nature. We all know that so many people who are out there, they're saying, hey, if I have cash, I'm going to spend it. So if I have $20,000 and I only spend $4,000 on a car, I'm going to find something to spend that other 16 grand on. Or maybe not all of it, but maybe 6 of it, right? And then they're only investing 10K instead of the 16. So they warn you not to do it, but they're acting like everyone is just a robot. Even though human nature, most people are just going to turn around and invest that extra money, or spend that extra money rather than investing it. So that's problem number one, is that even though they say to do that, most people won't actually invest the difference. Now, I see what you're all saying. You're saying, hey, leverage can be a good thing. It's not necessarily that risky. And sure, I mean, there is risk to it. And I think most people underestimate the level of risk they're at when you're living life really at the financial red line, right? If you have 100K in cash reserves and you can do this, then yeah, you can take leverage. But when you don't have any cash reserves and you're just making sure that every penny that you come in, that you make, is spent on your bills and then everything else is invested, well, there's no cushion there. And that's really the big problem, is that there's no real cushion in case something goes wrong, in case your inflow stops, right? It's all about being cash flow neutral, I guess, right? Making sure you have no cash and that everything comes in, either goes to one of two things. Either goes to pay off your debt payments, or it goes, and the extra all goes to investments and keeps your investments afloat and doing that. So the problem is, what about when you miss a paycheck, right? Whether you get fired or whether you change jobs or whatever, it's really living life too much on the financial red line, right? You're just revving your engine all the way up, and you're just really taking a lot of risk because you don't have a cushion in case things go wrong. And some people, obviously, they're going to build up their cash cushion first and then start leveraging. You can do that, but you still need to recognize that, hey, if you fail to make your payments, you lose your car. And they go a lot more than this. They talk about leveraging everything. Anything that can be used as collateral, hey, finance it, get a small interest rate, invest the difference, and you're just going to make so much money on the difference. And they talk about doing this with your house. It's just a dumb idea, right? To take out money instead of putting it towards your mortgage and to invest that difference. Now, I know people are going to have mortgages and investment portfolios, but specifically with this particular piece of advice of these authors, they said, hey, make sure you never have more than 20% equity in your home. Always keep that rolling. Always be pulling out any equity. Let's use an example here. So let's say you have a $300,000 house. So you have your 20% always in equity, so that way you don't have to worry about PMI, right? And so you have your $60,000 in equity that you say, hey, I put $60,000 as a down payment in my house. And then two things are going to happen as time goes on. The value of your home is either going to go up or down, and everyone likes to think that real estate always just goes up and up and up and always appreciates. That's not true, but the value could go up, but it is going to change over time. And the other thing is that as you're making your payments on your mortgage, naturally you are going to be dipping into that principal. As you all know with mortgages, those first couple years are almost all interest payments. You're barely tapping that principal, but you are doing a little bit. You're putting $100, $200 towards your principal each month. And so your principal equity goes up. So you start at $60,000 equity. And then maybe, over the course of the next year or two, you have a few $1,000s that go into your equity as far as principal, paying down your principal payment, right? So you had a $240,000 loan. Now you only owe $235,000. So you have an extra $5,000 in equity. And maybe your house now has gone up, and over the course of a couple years, now it's worth $310,000. Well, they say, all right, your house is worth $310,000 now, and you have an extra $5,000 in that you got in equity for paying down your principal. Extract that extra $15,000. It's a little different with the 20%, but whatever. We'll just say it's $15,000, right? You paid down the mortgage 5%. You paid down your principal $5,000, and then your house went up by $10,000. Take out that extra $15,000 in equity and go and invest it. This is your house. Like, if anything goes wrong, you lose your house. And you're homeless. Like, they never really beat that point home. Like, they give a little disclaimer here and there and say, this could be risky. We know that there's no guarantee rate of return. You're not guaranteed that your investments will make 8%. But over time, averages, here's what happened, right? This is complete survivorship bias. These guys did this, and it worked for them. And then they turn around and say, everyone should do the same. But if anything goes wrong, right? If you miss a single paycheck for whatever reason, or 6 months worth of work, right? Like, you're out of work. I mean, what is going to happen to your entire financial empire? That's when you have to start, when you're taking out losses, right? And so we talk about buying high and selling low. Buying low and selling high. There we go. We got that one. But then we see people who always sell low. And why do they do that? Well, one reason why they do that, sure, there's fear and they want to get out of something that's falling. But a bigger reason why people do that is when they're forced to, right? When they need to raise cash, they need to raise capital. That's the problem with not having any type of cash reserves, is that you're saying, hey, I have these 3 investments, right? A, B, and C. And they're doing okay, but they start to take a downturn. And it just so happens that as they take a downturn, I'm also suddenly out of work. Well, now what? In order to make my payments, I have to sell my assets at a loss, right? Because I just need to. I need cash. I need to make my debt payments. I'm not going to have people come and collect on my car and get that repoed. I'm not going to have my house repoed and foreclosed on, right? To avoid that, that's when you have to start selling and locking in those losses. Because on paper, if you own an asset, an investment that's going up and down, it doesn't really matter where it is until you sell it, right? And so if you're forced to sell it on a downturn, because you need to raise cash. What were you doing? And so this is why this is such a scary method of investing and trying to get rich or trying to become a millionaire by the age of 30, is that yes, on paper, mathematically, I get it. It's not that difficult. You borrow at 4%, you invest it at 8%, and you make 4% with someone else's money all on debt. It's great. Sweet. Give me $1 billion and invest that at a net 4%, right? Awesome. The reality is life doesn't go according to plan, and there's a lot of variance in this, right? Like, what if there's just a big market downturn as soon as you do this? And what if your property goes down in value, and so instead of your house being $300,000, now it's $280,000, and the bank says, hey, we need more money, or else you don't have your 20% equity in there, and your LTV is too high, and we now need to, we're going to start charging you a PMI. Well, you don't want to do that. You want to avoid that. You want to avoid PMIs, so then what, right? Like, you have to put more cash into the bank and give the bank to pay your principal down so you can have that LTV at 80% or below, right? That 20% equity. These are the issues and the unpredictable factors that the book doesn't even acknowledge. It just blew my mind that it just said, this will just happen. Not to mention any of the emotional factors going on here, right? We mentioned a little bit of, hey, the reality is a lot of people will go out and spend, right? They won't invest the difference. They'll take that extra cash and go put it on something consumer. But the problem is not just that. There's also a lot of fear involved, right? It's terrifying to do this. And that might force you to make some bad decisions, some bad investment decisions, some emotional decisions. So you're saying, hey, I really want to get this. And why do we need to be a millionaire by age 30 anyway? Like, that's cool. That's awesome. If you do it, great. But do it in a way that's not so terrifying. It's just not worth it. Not to mention, think of all the stress that you have. It didn't even acknowledge that. Even if this all works out, and you don't end up having a ton of fear and panic selling and oh, my assets went down by 5% in a day, so I now need to sell before it goes down another 5%, and you lock in those losses. Even without all that, just the stress for the average person of having all these debt payments and just being this machine where every penny comes in, goes out immediately, and you don't have any reserves, that's a scary way to live life. It's a scary way. Now, I'm not saying you can't use leverage in any form. I'm not saying you can't have both your mortgage and your investments at the same time. I get that, and I get whatever. I'm not here to decide which way to do that. I'm just going to fence it on that, right? Isn't that what we do? We just fence it and go with the populace? Cool. All right, that's what we're going to do. The point is, realistically, having just your entire life leveraged is just too risky, right? These guys talked about their experience that they did it. They don't talk about all the experiences of people who try this and it doesn't work out. It's just a really high risk way in trying to just take everything you can and just leverage it and put it all, and you take out your HELOC, so then you can say, hey, because I have a HELOC, right, that home equity line of credit, well, now I can start buying others. It's essentially like a credit card, right? So now I can start buying my TV on it, and it's only 5%, but I can invest the difference, and on that 8%, I mean, it's a slippery slope, and they basically say, hey, not just your car, not just your house, try to do everything you can, and HELOC is a way that people can leverage that. Just relax. Just calm down. You don't need to be a millionaire by 30. Again, if you want to, great. Do it in a safer way. But realistically, this life is a journey. There's going to be ups and downs. There's going to be variance, and that's fine. But you want to prepare yourself to be able to weather those and not just be living your life at that financial red line. That, to me, is just terrifying. Happy Halloween. Hope you're all enjoying your October, eating your pumpkin spice, your pumpkin pancakes, whatever else. Today's quote, like we said, we're going to start doing these. It's, we all have two voices in our heads, fear and love. The one you listen to will shape you. The one you ignore will fade away. Take care, guys.